mimicking the moves of global equities since the onset of the pandemic in early 2020. The stupendous rally in global markets was matched by the Nifty 50, and this was happening despite India not receiving even a fraction of the fiscal stimulus that developed countries had pumped into their economy. While the going was good and the rally seemed eternal, markets did take a breather on murmurs of interest rate hike in the US. Emerging markets like India have already felt the tremor with foreign fund outflows and now could well be staring at an interest rate hike as well. With inflation refusing to soften and competitive pressure to prevent significant depreciation of the currency, the writing seems to be on the wall. While it is prudent to brace for some more short-term weakness, the key question is whether investors should run away amid the softness or invest more amid the correction. We would unequivocally recommend that investors should use this as an opportunity to buy on decline, and the reasons are not that hard to find. In fact, we're here to tell you just that.
Unlike the past, when FIIs used to rule the buses, the long-term journey of Indian markets will ride on domestic liquidity. The record number of new demat account openings and the soaring monthly contribution to SIP stand testimony to the same. This domestic liquidity should provide downside support to equities. On the other hand, earnings look stronger than ever before. The revival from COVID's second wave has been sharp and swift in India. Growth is looking up, and the impact of COVID has been positive for organized players who have pushed the efficiency to the hilt and managed their houses well despite extreme gross margin pressure due to rise in raw material prices. We don't expect any major negative earnings impact on Nifty in the next couple of years as the two heavyweight sectors, financials and technology, look to be in fine fettle. Riding on recovery and better asset quality, we expect financials to manage the marginal pressure on interest margins. And the unprecedented demand for digitization and the gradual easing of talent shortage augur well for tech earnings, and the currency depreciation could be a feather in the cap. Diversified heavyweight conglomerate Reliance Industries should continue to benefit from recovery in all its businesses. With very little weight of cyclicals, we rule out a meaningful downgrade to Nifty earnings. A look at the historic forward valuation of Nifty doesn't point to overvaluation, especially in the light of the robust earnings outlook.
The recovery could ride on earnings, and investors got to place their bets wisely. A bottom-up, stock-specific approach towards companies with strong earnings outlook is highly recommended. From a top-down perspective, MC Pro is betting on export-oriented sectors ranging from technology to chemicals. Leaders from financial pack and high-touch sectors, whether it's travel or hospitality, essentially sectors that are benefiting from COVID recovery, could see strong earnings. On the industrial side, companies with order book visibility, lean balance sheet and minimum leverage. And of course, companies that are poised to gain from Atmanirbhar Bharat and hence from the various PLI schemes should be on the radar. Overall, we expect the year 2022 to be more stock-specific for investing with an overall positive undertone, unlike the jitteriness that was seen at the end of 2021 when markets were staring at a myriad of short-term uncertainties.